So, Rob, maybe I'll come to introducing you, JC, in a moment. Maybe Rob, because your work is, I think, directly connected to our discussion today, maybe you can introduce yourself briefly, what you're doing.
Thanks, Gerhard. It's a pleasure to be on the call and be with JC. I was struck by the title of the call, given my role here at BNP Paribas in Hong Kong. My role is to look after what we call sustainable finance for the commercial banking side of our business here in Asia. BNP Paribas, French headquartered bank with global presence. I'm sure that you're aware. So the role is, my official title is Chief Sustainable Business Officer, and I sit with the corporate and institutional banking side of our business. So we're very much looking at the role of sustainable finance for allocating capital to the benefit of a better society. So maybe we can come back on that point. I'll stop there.
Thank you. That's fantastic. I should also mention that we have a discussion in January coming up with Professor Shackbury, who is the chief of Cambridge Zero.
Yes,
which is
Dr. Emily Shackbury. I've met her previously in Cambridge.
Oh,
so
okay.
I'm looking forward to that call as well.
Great. So I hope you'll be there. So now we'll start with Professor JC DeSwaan, who is in one of his many roles, he's professor at Princeton University and has been teaching for many years. And he has written, he has published a very important book recently. And I think you will follow maybe some of the points here today from your book. I'll call you JC if you permit.
Yeah, of course.
And so let's start. Thank you. We are all very, very interested to hearing your views.
Great. Well, Gerhard, thanks so much for having me. And by the way, I can't wait to go back to Japan. It's been I used to go to Japan every 3 months, and since the pandemic, I haven't been in Japan. So I'm sitting here in New York City where I live. And so let me introduce myself.
Yes, please,
and
yes.
I can say a word, like just a short word about my path and what drew me to the topic that I want to broach today. So I divide my time between teaching and investing. At Princeton, so I've been there for about 12 years. I teach a course I created on the ethics in finance. And I also teach a course I created on Asian economies and capital markets. So that's about half of my time. And the other half of my time, I'm an investment professional. So I'm a partner at a fund called Cornwall Capital. We are a quirky fund in the sense that we have an unusually broad mandate that allows us to invest in anything, anywhere, which is unusual these days, but ultimately we're a special situations fund, and we're very thematic. The areas that I've focused on in recent years have been constructive activism in Japan. I've also focused on global macro opportunities, and I'm pretty involved in several of our private equity and VC investments. So it tends to be very esoteric, but very broad. I should mention, of course, that I've adored my time at Trinity and in Cambridge. And in fact, I've kept strong ties with the university in that I've gone back to Cambridge every year since I've graduated, and I've taught at Cambridge for the past 10 years. So I teach there in the Easter term at the Judge Business School. They basically allow me to condense an Easter term course.
We have the new, I'm sorry to interrupt. Judge Business School has a brand new dean. And in February, we have a discussion with a dean coming up in an event similar to today.
Yeah,
so you have time,
I saw that.
If you join.
That should be very interesting.
I'm sorry, it's a bit out of time zone for you. So you might have a sleepless night with us. If you join.
Yeah, and I'll mention I've also published my book with Cambridge University Press, so I've retained strong ties, and every year. I can't wait to be back there.
We have also the representative of Cambridge University Press for Asia Pac is one of the Trinity alumni. And he regularly comes to our dinners. He didn't attend our Zoom discussion today, but he comes to our dinners. So if you come to Tokyo, when it's possible again, I'll set up a dinner at Trinity Japan event for you. And we can have lots of discussions again. Sorry.
That'd be great. So I was always interested in this concept of finance as a force for good and as a tool for economic development. When I was in Trinity as a grad student, I studied economic development, and then I went on to study public policy at Harvard, and then went on to work for a few years for a management consulting firm, McKinsey and Company. But I thought about it more as a graduate degree in business. My real interest was really finance as a force for good. And what was interesting when I studied economic development back in the 1990s, at that point in time, we really never talked about finance. Like it wasn't part of the field. Finance was generally seen as part of the plumbing, and it didn't merit attention, right? And it's only like starting in the mid 1990s, late 1990s, that we start seeing research partly from the World Bank, from a few US universities, that try to understand the linkages between finance and economic development and between finance and society. And generally, the tenor of that research is very much trying to focus on what are the positive linkages, like in what way is finance a force for good. And that's something that I thought was very exciting and interesting, and I became interested over time in this notion of investments as a catalyst for economic development, and I wanted to test it out myself. And that was partly what I researched and worked on when I was at Harvard. And so I thought, okay, well, let me try it out. I'm going to move to the buy side. And I started by working in a long-short equity fund that was dedicated to Asia. And that's why I mentioned to Rob, I used to be based part of my time in Hong Kong, and we invested in most liquid markets across Asia. So it was about a dozen markets at that time. And it took me about, I would say, like, a few weeks to realize that as an analyst in a long-short equity fund in Asia, my personal impact would be close to zero, like in terms of my practical experience, in the sense that we traded mostly in secondary markets, and we were buying and selling shares mostly with other institutions, and there were other hedge funds and and some asset management firms and so on. But I didn't really see the impact that I was hoping for, and that led me to try to think more deeply about what is good about finance and why is it a force for good. And this is when I decided I would start to teach, and I created this course really as a vehicle, in some sense, more for me to try to be more thoughtful about the dynamics and the impact of finance. And so I created this course on ethics in finance, but it's partly about the social value of finance. And I'll mention as well that when I started teaching it some, a dozen years ago, halfway through the first semester that I taught it, one of my students came to me and said, why is it that when we talk about ethics in finance, we tend to focus on mostly the negative aspects of finance and unethical behavior and so on? And she said, why not focus on what's good about finance and and particularly inspiring people and constructive behavior? And I thought, of course, why is it that we don't focus on that? And I looked for the literature on it. And of course, you had that emerging literature on the impact of finance on economic development, but you didn't really have much of a literature on role models in finance. And so that's been an important part of my research over the last few years, which is trying to understand, well, first of all, identify role models in the industry and understand how they thought about their kind of career and decision-making process. And out of that, I teased out a framework, right? And the framework aspires to be a framework for how to be virtuous in the finance industry, and that's the book that came out, the Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry. And I'll just mention for context the very simple framework that I teased out of it, and it's essentially 4 pillars to be virtuous based on these individuals. One, the first pillar is serving your customers' interests, or serving your customers with their interest in mind. I don't think that will surprise anyone, and that's the most important pillar because that's our professional mandate, right? And the second pillar is serving your customers well without extracting value from the rest of the world. And that's a real conundrum, I think, in finance, is that there's a lot of opportunity to serve your customers well and do well for yourself, but do so in a way that is extractive of other stakeholders, of the rest of the world. And of course, what's interesting, when I started this research, which was really 7 years ago, ESG wasn't as much of a revolution as we're seeing now. And of course, now the finance industry, there's been a dramatic shift towards trying to be more thoughtful about that second pillar, which is wonderful, right? It's incredible how much of a shift we've seen in the industry in recent years. But so that's a critical pillar, that second pillar. The third pillar is now looking within the organization, and it's something that I think we tend to underplay, is the extent to which finance professionals treat their colleagues and employees with dignity, with humanity, help empower them, help develop them, and to what extent they help promote diversity within their organizations, within the industry. Arguably, of course, this is a less of an important pillar simply because the constituency is smaller than for the first 2 pillars, but it's a critical one, and it's one that I feel is, tends to be underplayed generally. And then the fourth pillar, and in some ways that's the pillar that I think, in my mind, was the most intriguing to pursue and to try to understand, is the extent to which a finance professional uses his or her skill set and the network that they've derived from their experience in the industry to pursue impact outside of their day job, right? In parallel to their day job, or perhaps after they've left the industry. And it's this concept of citizenship. And it really, this came out of the dozens and dozens of interviews I did. And it's this idea that in finance, we're lucky in that our skill set is tremendously versatile and can be applied to all sorts of domains outside of finance in a way that can be beneficial to specific causes. So that, in a nutshell, is the framework. And today, the topic of the conversation is the social value of finance. And inherently, it's really more about that second pillar, which is, are you serving your customers by extracting value from the rest of the world, or by adding value to the rest of the world, or at least by not extracting value from the rest of the world? And that's broadly like a topic that people are very much focused on. So that's the context. I would so let me, for my kind of comments, let me structure the rest of them into 2 broad segments. One is, let me go over my review and understanding of the social value of traditional asset classes. And for the book, I was very interested in understanding what is the impact of the vast majority of existing asset classes and investment strategies, whether it's VC, PE, shareholder activism, global macro, derivatives, I mean, you name it. I was really eager to understand what are the spillovers what are the indirect consequences of being engaged in these strategies, right? And then in the second point, I can talk about the ESG revolution. Obviously, Rob will have a ton of experience in that space as an active participant, and would love to hear, Rob, your insights if you're able to stick around, because I'm sure you'll have a lot to add here. So let me talk a little bit about my review and my understanding of the impact of traditional asset classes. And let me start by saying some very simple points, which is at a macroeconomic level, the fundamental purpose of investments is to channel capital to its most productive uses. And at a microeconomic level, the fundamental purpose of investments is to generate attractive financial returns on behalf of the owners of capital. And the question is, how do you think about the social value of investments in that context? And I would say, well, the first thing you might want to think about is the extent to which an investment benefits the investor, meaning the owner, and in this case, specifically the owner of capital and the fund manager, who benefits when the investment succeeds. And that points to that first pillar, because you have to start there in a sense. The question merits attention, even from an economic and social point of view, because an investment that doesn't generate an adequate financial return over time reflects an unproductive and unsustainable allocation of capital. So I think that's a starting point that's important. Now, assuming that bar is clear, I propose two channels by which an investment strategy can contribute to society. And the first one, I would say, is by fulfilling a role in supporting the sustainable functioning of the real economy. And that can be reflected in positive externalities, like positive contributions to certain economic indicators, such as growth, employment, productivity, research and development, innovation, even if the effect is small and indirect, right? Because of course, you're looking at it, I'm looking at it from the perspective of the agent, the individual investor, and trying to understand what is the impact of that investor. And that ties to the ESG world, of course, because now we've become increasingly sophisticated in understanding what the impact of individual investments are in a way that, is very different from, even I would say 6-7 years ago when I started looking at that. And of course, it can be also observed in the diminished environmental footprint, right? As measured by all sorts of things like emissions and water usage and waste per unit of production. So that, broadly speaking, I would say is the first way in which, the first channel by which an investment can have real social value. And that is the very much the focus of the ESG world. The second channel that I like to highlight, and it's only relevant to certain strategies, is the extent to which an investment actually contributes to improving the investment's underlying business or assets. Now, it's only relevant to a subset of asset classes and strategies because that is the domain of activist strategies, right? And in particular, venture capital, private equity, and shareholder activism in public markets. And I devoted particular attention to these three prominent activist strategies. So VC, PE, shareholder activism, because they're the ones that most explicitly seek to have an impact on the underlying business that they invest in. And I'll say something that is probably self-evident to a lot of people who are involved in the industry, but assessing the economic and social value of investments is it's such a layered, complicated affair, right? It entails parsing out indirect effects, unintended consequences. It requires weighing positive effects against negative ones. There's a timing challenge. There's a substitution one. For instance, one example, as I was reviewing the data that I'll discuss in a minute about, what's the impact of venture capital or private equity on employment? Now, how do we think about that? Is less employment always bad, right? It can lead to greater productivity. There might be a reason why, it's actually a positive thing. If you invested in a Chinese state-owned enterprise, a lot of these enterprises are bloated and have probably too many workers, and for very understandable reason, is because the company is run on behalf of the state, and they have dual goals that often conflict. So lower employment is not always bad, and when we look at like the empirical data, sometimes it's hard to parse out when you look at the employment data whether it's good or bad. We generally believe that more employment is good, and that's probably the case, right, for most of the time, but it's not always the case. So one big caveat, of course, is that as you look at all this data, like positive, what looks like seemingly positive effects can be misleading, and at times it clouds the data's interpretation. And the other point I'll make before going over, and I'll go briefly over some of these strategies and the takeaways, is that our intuition, or let me state that a little bit more narrowly. My intuition is that certain types of financial transactions or investments were going to be inherently wealth creating, right? And that's not always supported by the empirical data. And that leaves a question mark, because it's not clear to me always whether that means we know for sure that the data points to something that's counterintuitive and that as a result it is what it is, or whether it's hard to get the data that we want. And I'll point out a few examples, right? So let me delve into just a few strategies as examples. And I'll start with perhaps the easiest one, which is venture capital, because VC, it may be the one traditional returns maximizing investment strategy that is mostly immune to second guessing of its social value. It's widely recognized as having played a critical role in the development of the most important technologies that we use nowadays. And in fact, it is so widely recognized as a force for good that we have seen numerous governments around the world that promote their VC industry, right? And in fact, Japan has been doing this, and you've seen local governments do this. Paris has been very deeply involved in trying to develop the VC industry in Paris in ways that have been quite successful. Berlin, right? And Israel for quite a few years was focused on this, and now, of course, they've developed a thriving VC industry, and the linkages between that and macro indicators seem very intuitive to people and very clear. Now, let me start by saying, okay, well, we should first start at the returns of the industry to understand, is it an industry that actually is meeting its risk return targets? And on the face of it, it does, right? I mean, if you look at the data, so if you look at, say, Cambridge Associates 30-year IRR stands at about 20%. And then you can compare that to public market equivalents, and the comparison is actually quite positive for the VC industry. Now, if you delve into it a little bit more deeply, so at a high level, it's an industry that's done very well. If you delve into it more deeply, there are some other dynamics at play here. One of them is that there's no such thing as an average return in VC, because I'm paraphrasing here, but I think something like 20% or 80% of the industry's profits are actually generated by a handful of VC funds, and a lot of VC funds don't do nearly as well. And there are other dynamics that's at play, but by and large, it's quite successful. Now, what about the social value, right? What about the externalities of the industry? one way you could look at it is to what extent it's actually improving the businesses in which they invest. And here the evidence is pretty clear. They tend to, so startups that have VC investors do better than startups that don't have VC investors. And there are all sorts of like empirical data that suggest that VCs have a very significant positive impact on, on the companies they invest in on average, right? Now, the other angle is to what extent they create positive spillover effects outside of the companies they invest in. And here, again, the data is pretty solid. So, I've seen data, studies of US metropolitan areas, for instance, that show that VC capital stimulates the creation of new firms, and it tends to be positive on economic growth. So in general, I think VC is relatively uncontroversial at that level. Now, this being said, this is not to say that there's no controversy, right, with VC. And obviously, one of them is that there's a herd-like mentality in the industry where at any given point, there might be half a dozen niche areas that the industry obsessively focuses on at the expense of everything else. So there are lots of areas that are underfunded as a result. And then, of course, there are all sorts of debates around the fact that some of the issues that we're seeing with large tech companies today, like issues around privacy, for instance, monopoly issues, were at core driven by not only the founders, but also VC funds that are behind, like push really hard in those directions and instilled a certain culture that permeates the industry. But overall, I think VC industry stands out for on the data seemingly like very positive, right? So let me say a word about private equity. Now, private equity, I was particularly interested in, so I'm involved in private equity, but it's also because that one has, and I would say from the perspective of someone who's involved in the industry, surprisingly controversial and negative reputation. And that has been, I think, particularly true in the US since 2012, because it's come to the fore starting in 2012. This is when Mitt Romney, so the founder, or co-founder of Bain Capital, which is an extraordinarily successful firm, ran for president. And so he was the Republican nominee. And that created a whole public debate around private equity. And generally, private equity came out diminished from this reputationally. And I was surprised because, from my perspective, the fundamental underpinnings of that strategy should make it theoretically a tremendous force for good in society, right? Because at its best, private equity professionals, what do they do? They instill greater analytical rigor in the firm's capital allocation decisions, greater discipline in measuring, monitoring performance. They put in place incentives. They bring to bear tremendous networks of people that go on their board, an ecosystem of advisors. I mean, there are all sorts of positive things, right? Now, of course, there are other aspects of this, and primarily like the financial engineering aspect of private equity, which is depending on what kind of private equity you do, but if it's LBOs, it typically entails a huge amount of leverage. And that has created some issues over the years, particularly to the extent that the amount of leverage has been pushed to its limits continuously, right? So now, when I looked at the returns of the private equity industry, they're also quite positive in the sense that if you kind of look at it from a risk-return perspective, so the index has returned something like 13.5%, I think, over 25 years. And you compare it to a public benchmark, risk-adjusted for one, the leverage that you see in the private equity industry, and two, for the type of industries that they're involved in, and three, for the size of the companies they're involved in. private equity industry does better. Now, it should do better because there has to be an illiquidity premium embedded in this, since when you invest in private equity, you're locked up for 10 years typically, and that should count for a very significant premium. But still, the industry has done well, and you know, practically speaking, we know it's done well just because we see the massive flows that have gone into the private equity industry in recent years, right? Which, of course, bode negatively to the future returns of the industry. So that's maybe, kind of. You know,
if I can just pick up on one point there, maybe to ask a question, just to clarify on PE. But firstly, thank you very much for all of the said. We could talk forever on this. On PE, when you talk about the efficiency and rigor of the capital allocation, are you broadening your view to a financial lens only to include other elements of capital, as in the natural capital and the social capital? And when you say better, is that in a financial term only, or do you think that there's a mechanism now for a broadening of measurement of what is called better?
Yeah, I mean, I use the term pretty loosely here in terms of, this was in the context of why I think theoretically the private equity industry should be a force for good for society. And the idea is that the average company will be a mature company. So most of the data is on LBOs, right? So mature companies, and private equity funds are going to take control. So most of the time they buy 100% of that firm, and then they instill a rigor in terms of the allocation of capital. And I would think of it very broadly, not just, so first of all and foremost, of course, the financial capital is how they allocate their own financial resources. But then, I would think of it more broadly in terms of people resources, right? And all sorts of other resources. It's just, there's, I would simply put it as, there's an analytical rigor that they bring, which I think is a force for good. And at a minimum, it improves these companies in the way they're managed. So from a returns perspective, the private equity industry has done well. Now, from a social value perspective, right? And so if we think about the empirical research that is out there, trying to figure out what are the externalities and the spillovers from the private equity industry. And I should say most of the analysis that I've seen tends to focus on US and UK and France. There's other analysis out there, but the bulk of it has been on US and UK actually. And again, this is LBOs. And the research that I've seen suggests that PE firms tend to improve the companies they acquire. And on average, they tend to boost operating margins, cash flow margins, and productivity. All right, so that's the first thing. And now my intuition is they would do that, and the data seems to bear that out, right? So not a big surprise there. There's no evidence of decreased patenting activity, which I think is a big concern, right? Because the concern with private equity, which is a real concern, is that private equity funds come in and they're going to lever up dramatically mature companies that have steady cash flows, and then they're going to gut them. And like an easy way to gut them is to just reduce dramatically R&D, cut costs, to the point where they're going to be able to generate higher cash flows over a short period of time, say like 3 to 5 years, just enough for the private equity firm to flip the company, but then it will leave that company worse off, right? Worse off. And the data, surprisingly to me, actually doesn't suggest that on average there's decreased patenting activity. And I would say surprising because I do feel like that's an important dynamic in the industry. But at least, that's what the data shows. And again, I want to go back to that point that I'm not suggesting that the empirical research is the end all be all, because one, they're necessarily limited in the data that they were able to gather, and two, sometimes there are cognitive biases that seep into these studies because you start with a point that you want to prove out, and then you prove it out, right? Overall, the picture on employment is more mixed. So the recent studies I've seen show that employment tends to increase, but more slowly than at other firms in the same industry. So that's another way of saying that they tend to run leaner. And so the question is that a force for good, or is that a negative thing? That's always hard to interpret. Now, what we do know is that there are tremendous successes in the industry. So that's the empirical data, and the empirical data is relatively positive, not as clear-cut as the VC industry, but it's relatively positive. And but you have to mention there's a qualitative layer here, which is there's no question that there are so many excesses in the PE industry, even for me as a participant in the PE industry, that raises a lot of concerns, right? And those are around excessive leverage, right? And it's typically, I mean, like what we've seen in recent years is the trend towards dividend recaps that are just excessive, right? And this idea that part of the reason why private equity industry is so attractive theoretically is that the interests of the new owners are completely aligned with the company's medium-term interests, right? But now there's a way in which a lot of private equity firms come in, they take control of these companies, and they de-risk themselves within the first 6 months of ownership by doing a dividend recap, by levering up the company dramatically. And so now they've already recouped their investment, and now these interests, the company's long-term interests, or even medium-term interests in the interest of the owners, so the PE funds and the owners of the capital that the PE funds deploy, completely diverge, because now the PE fund is looking at this as an option, right? And so it's in their interest to take a lot more risk than you would otherwise to boost the short-term performance of the firm. And we've seen, numerous case studies of that dynamic going, sideways, and the wheels coming off, because then you're dramatically at the mercy of a slight change in the business cycle. Any kind of miscalculation, any kind of slowdown for either macro or idiosyncratic reasons, and the company can go bankrupt very quickly, right? So private equity, I would say, slightly positive, but with some concerns around the dynamics of that we see that are prevalent in the industry, particularly when it comes to large cap PE funds. And then let me mention shareholder activism. So that's one that's very dear to me, because I'm so deeply involved in shareholder activism. And I would say here again, in theory, shareholder activism should benefit society, right? Because I mean, like, here are companies that go in and they focus on governance typically, and you would expect improvements in governance to be positive. Now, the data is not nearly as supportive here. And so first of all, the economic returns, not nearly as solid as VC or PE. It's slightly above the benchmark, the public benchmark, and it's a public equity strategy anyways, but the data is not quite as strong and supportive. Now, in terms of the social impact, here the evidence is mixed. The studies that I've seen show that activists tend to reduce R&D, and that's a clear issue. Now, so again, there are companies for which you might argue, well, it's actually a good thing. This company shouldn't be deploying 10, 15% of its revenues on R&D, But for the most part, I mean, that's a sign of shorter term investment horizons that is a negative, right? The evidence on operating performance is also mixed, and that's a surprise to me, but that's most of the studies I've seen show either little tangible impact and a subset show negative or positive impact. And what it does show is that it typically leads to increased leverage and increased cash returns to shareholders. So I came out of this looking at that data and thinking, okay, so the average activist comes in and basically pushes for cash returns to shareholders in ways that may be beneficial to the economy in certain cases where you might have bloated companies that are probably not particularly productive, but on average, maybe just a short-term returns boosting strategy that may not be helpful to the company long-term nor the economy. And Rob,
quick question on that point, JC, if I may. Did you look at the motivations? You mentioned timeline of the activist elements of the piece. Did you look at the motivations behind the activists as that's one question. Did they have different motivations and also different timelines of that, but motivations of belief? Has that been something that can be quantified in terms of where they start from before their activism? Is it purely financial gain or other different considerations that may be motivating an activist piece? We've seen from some of the funds in London, there's a different agenda coming through on the activism or specific agenda. And then second, is there a sector bias of the sectors in which the activism is more prominent or less prominent? And I'm thinking from the climate meetings recently.
I would say, so first of all, in terms of motivation, no, because that would need to be inferred from the data, because the problem is that every single activist will say they're there to create long-term value. And within that, the problem is that if you really want to know whether they're there to create long-term value, all you need to know is to understand how short or how long their lockup period is with their limited partners. And the more successful they've been over time, the longer their lockup, the more they can actually truly seek to create long-term value for the firms. But if they're not, and if they have the typical, either monthly or quarterly redemption availability to their capital, then they're going to go in and they're going to try to boost the share price very quickly. And typically, there's no silver bullet here. When you try to boost the share price very quickly, you end up doing things that are typically detrimental to longer term value. Not always, but often, right? Now, in terms of industries, I haven't seen the data that goes industry by industry, but what I do believe is fundamentally important when we think about shareholder activism and its social value is the geography. And to me, that is critical because, so let's pick the US, right? As an example, in the US, markets are ultra sophisticated. Companies are already very, very motivated to do well, right? CEOs are compensated, often in ways that are linked to their operating performance and to the share price. So there's no lack of motivation typically there. So when an activist comes in, it's not often in the US now that you see low-hanging fruit, right? Where they can come in and have an impact in ways that are simple. Now, contrast that to Japan, right? In Japan, it's over 50% of the companies that are listed are net cash. But they're also not in markets that are seeing much growth at all very often. And the cash has been hoarded over time just for the purpose of stability. The CEOs are not motivated to boost performance. Now, I mean, I'm not even talking about the share price, just performance, because their compensation typically is not tied to performance in the first place. They typically don't have ownership in the company, or very, very minimal ownership. And there, my sense is that there's a huge, huge opportunity to improve the productivity of these companies. And of course, you know, I mean, I'm talking my book here because I mentioned my largest focus in recent years has been constructive activism in Japan. And there's no reason for me to be involved in Japan outside of the fact that in 2013, Abe pushed through the corporate governance reforms. We have a view that it's a fundamental change that's taking place slowly, but dramatically. And in our experience over the last 7 years, we've seen just a dramatic shift in the way companies interact with us and the kind of value that we can create there. And so in my mind, if you did a study, I haven't seen them, right? But if you did a study on shareholder activism in Japan, I suspect that there you would show interesting positive spillover effects, right? Because there's a huge need for activism in a way that is completely consistent with what the government's trying to do with its corporate governance reforms. And in fact, my observation, and I've written about this in various articles in recent years, my observation is that the government has been tremendously supportive of shareholder activism. They've been, and foreign activists, right, to the extent that we're not confrontational and we're not short-term. For us, you know, when we go into these companies, we go in with a 5-year time horizon. We try to build trust with management, and then we try to work with them in a partnership. And typically it's not to return cash to shareholders. I mean, typically that's not our focus at all. It's typically like all sorts of other ways to try to create value. And sometimes it's actually about, you know, acquiring other companies because they're subscale. It might be their HR strategy. It might be the way they, you know, set their internal performance targets and incentives. Or it might be their international expansion strategy. But there's a tremendous amount there, and you know, even though the data on the industry as a whole in shareholder activism is not supportive of the fact that shareholder activism is a force for good, at least in, you know, in a way that's clear cut. I'm a tremendous believer that in certain markets, it's a tremendous force for good, and I would put Japan on top of that hierarchy. And one last point about shareholder activism. Curiously, I have found that there are no studies that I've seen that try to link corporate governance to macro indicators. Right? And it's very curious to me because when I speak with some of my colleagues at Princeton and I bring up corporate governance, it's not intuitive to them that improvements in corporate governance are going to have positive spillovers on the economy. Whereas it's completely intuitive to me, but they think of corporate governance as, okay, well, you're going to return cash to shareholders. What's the big deal? How is that going to move the economy and economic indicators in any way? And I, you know, I was always intrigued by that reaction because it's exactly the opposite of mine, and I just haven't been able to find that research. And I think, you know, my hypothesis is that the reason why we haven't seen that research may be because it's often the case that business schools and economic departments don't talk to each other very well, right? They're on the same campuses, but corporate governance is really a business school topic. And of course, macro is an economic department topic. And it may be that there's a mislinkage there, but there needs to be more research on that.
Very interesting. The corporate governance has often been said here that governance in the ESG construct, good G manages good E and S. as from a board perspective, and from a bottom-up perspective as well, from top-down of turn a company and bottom-up from the employee. I suppose the question that I have, again, following the COP26, where we saw a huge element of the private sector on within the same construct of COP, but not within the meetings necessarily, because it's a government to government, but the presence of the private sector and obviously the whole of the financial system represented. I suppose my question, JC, would be for certain sectors like oil and gas, where the financial system, from my point of view, are trying to transition or support companies that have legitimate transition plans aligned to science trajectories of reduction of CO2 within the system. Does the element of governance and activism and capital source agnostic deployment of resource, does that breed a better potential discussion between those two sides of macro and economic, as you say, the gap? Would a sector like oil and gas, you have to test out the quality of the governance to see that potential return coming through?
I would think so. I would think so. I mean, I haven't thought about that, but intuitively that would make sense to me.
Yeah.
And I certainly think that if we ask that question to engine number one, right? So this is the activist fund that was in the news for having had extraordinary impact, relative to their size at Exxon a few months ago. I suspect that they would very much agree with that.
Yeah, I think so. So I think there's the sectors that could be in scope for that type of thinking. Could be certainly the oil and gas sector, the transportation sector, the food production and distribution sectors, and then elements of the industrial sector. It was quite interesting.
Yeah. So let me and I'm not going to go over every strategy, but let me mention two other strategies, but I'll do it much more briefly. Because they're so different, right? I focus on the strategies that actually seek to improve the underlying business here, VCP, shareholder activism. But I was also very intrigued. What about global macro, right? How do we think about global macro? Is it a force for good? Is it helpful? And global macro is a little difficult to analyze in terms of spillover effects, and because, now you're making bets on interest rates and currencies and so on. But there, so there, first of all, I didn't find any empirical research, right? Because I think the linkage is harder to establish. What I did find were very powerful, interesting case studies of the argument that global macro strategies can be a force for good by shining a light on economic problems before the public authorities, before the government is able to focus on it, right? And the great example, or the example that I think has been probably most studied, is the breaking of the British pound, out of the ERM in 1991. And the Soros trade, and this is a case study I like to discuss in class and debate with my students, because as you may remember, in 1991, the British pound was part of the ERM, which was a predecessor, in a sense, to the euro. And there was an upper bound and a lower bound, and it was really set by the German Deutschmark. And at that point, there was a discrepancy. There was a disconnect between the British economy and the German economy, and the German economy was doing much better. And so the German economy was very happy having fairly high interest rates. But if you had looked at the British economy on its own, you would have argued that its interest rates needed to be lower to stimulate its economy. And at that time, John Major decided that he would rather stay in the ERM and take the hit on the economy than bolt out of the ERM and the European monetary construct in order to have an independent monetary policy. George Soros and at that time, so it was Stanley Druckenmiller and Scott Bessent who were leading the charge at his fund, looked at this and said, this is completely unsustainable. The British pound it's going to get out of the ERM. Like there's no way it's going to be able to stay there because the economic cost is accumulating over time. And as a result, like it's a question of time. And so they shorted the British pound with a view that at some point they were going to have to stimulate the economy by bringing rates down, which would bring the British pound down. And the net effect, as we know today, is that George Soros prevailed. The Bank of England fought, right, and bought British pound in the market on a daily basis. And the net effect is that there was a $4 billion transfer of value from the British exchequer to a handful of hedge funds, primarily, the quantum fund led by George Soros. And the question is that a good thing? Is that a bad thing? And of course, we're horrified by this idea that taxpayer money goes to a hedge fund, right? I mean, there's something very distasteful about that. But at the same time, there have been a lot of studies looking at this 10 years after it, 20 years after it, and 25 years after it. And economic historians have generally had the conclusion that this was a very positive thing for the British economy. Like the idea that if it was forced to move out of the ERM to develop its independent monetary policy, and I don't have the numbers in front of me, but created a lot of economic value for British taxpayers.
So your argument is there that the private equity funds, so that the hedge funds accelerated development, which would have come anyway. So it would have accelerated the economic development, which, while if that would have taken place on a political level, you need to have society consent and elections or whatever. No? So it would take, it's far less efficient than you say the hedge fund.
They forced the acceleration of a policy that was going to come about, and in doing so, probably created a positive economic value. Now, this is one case study, right? And I'm sure we can come up with other case studies where the fund manager wasn't that insightful.
Where
right?
It goes the other way.
Yeah, and but I can see how global macro funds fulfill a function in global markets and global economies that is a positive, helpful one. And that's it's less quantifiable at on an aggregate basis, but that's one that seems reasonable to me. And then finally, I'll mention trading and derivative strategies. So in our fund, we do a lot of just also like derivative strategies that are completely separate from our private equity, VC, shareholder activism, and we'll do complex derivatives. And so I haven't seen studies on that, specifically on the spillovers here, but my intuition here is that it's hard for me to imagine any social value in these strategies outside of serving their customers' interests, right? And so at best, I would think that they're neutral on the economy, but that's at best. And the reason why I would say it's at best is because, one, when we construct these complex derivatives, so they're usually exotic derivatives, right? We'll go to one of our brokers and we'll say, hey, can you construct for us a multi-leg option that will do well if this happens to the yen and this happens to the US interest rates and this other thing happens there. It's not anchored in any way in the real economy. It doesn't support anything in the real economy. It doesn't have a real economic function outside of some kind of view that we could generate alpha from it. So that's the first thing. And the second thing is that it doesn't the risk here is that it creates all sorts of risks that nobody quite understands outside of us with our particular position. But I'm not sure the broker would have the hub view on all of the risk that's being accumulated at on a systemic level. And so the downside, I think, is that not only it's not necessarily serving the real economy in ways that are direct, but it also may create risks that are not well understood in the system. So
in this connection, I can ask about your views on high-speed trading, because that's always discussed about. They're quite how do you say? At global leadership level, there are quite a few people who are very much against the social value of high-speed trading. The kind of thing where you need to have the data center right next to the stock exchange because the speed of light plays.
No, absolutely. It's interesting because that's a question that comes up to me pretty often, actually, from my students. And the reason for it came up, I think, more often probably like 3 years ago, when high frequency trading was a huge draw on campuses and they were hiring a lot of students. And then students came to me and asked me, so what do you think of the social value of HFT, right? And I have to say, so I'm not, I'm no expert on high frequency trading. I've read, various pieces on it. Of course, I've read the Michael Lewis book. And I have to say that I'm unconvinced at the value of high frequency trading. I understand the bull case for it, which is that it makes markets more efficient, right? But you can say that about just anything you do in finance. You could say that about complex derivatives that we put on, and generally the argument supporting that is that it makes market efficient. But I don't know that making any random like marginal niche corner of the industry more efficient is helpful in reality. And efficiency, while it's it's a good in and of itself, it's not an end all be all, because it speaks nothing to the accumulation of risks that are not understood. It speaks nothing to the distribution of returns, right? And so I fully realize that there are sophisticated people on both sides of that argument for HFT, but I'm personally unconvinced that it's a force for good in the industry. Okay, so so these are the traditional asset classes that I thought I'd mention something about, and then I thought I'd say a few words about ESG, because obviously we're in the middle of a revolution, and it's and I want to make sure to say a few words about it, and of course, and Rob may be much more deep into this than I am in terms of the actual implementation of this. But to say, some simple, framing comments, particularly for, it's more for people that might watch this video that are not as familiar with it after you post it. Obviously, it's had a staggering adoption rate. And to me, what's absolutely fascinating is that I remember 12 years ago when I started teaching about the social value of finance and ethics in finance, we talked about ethical investing. And at that point, we started talking about sustainable investments, but it was still very deeply rooted in this concept of SRI, right? Socially responsible investments. And the thing that's absolutely fascinating for anyone that's been in the industry for a while and that's followed the arc of that evolution is that socially responsible investing was generally a negative alpha strategy, right? Like it was a very, like simply you screened out sin stocks, but in large part because when you did that and you were a small minority of the buy side doing that, you basically created opportunities for others to pick up names at at a lower price, and you reduced your universe of investable assets, and it ended up not being a strategy that was inherently popular just because there was a pretty clear trade-off involved. The thing that's fascinating about ESG, and the reason why it's so dramatically popular is that it's positioned as a positive alpha strategy. Now, the question is it credible as a positive alpha strategy? And I would say, so obviously there's an enormous amount of research being done on this and enormous amount of data. But the way I think about it is that I think it is credible as an alpha strategy from different vantage points. So the first one I'll mention is that certainly the company data seems to be supportive, right? When you look at the analysis on companies over time, those with high sustainability policies have tended to outperform the kind of matching sample, right? And over fairly long periods of time, right? So I've seen some, I mean, a lot of people quote the ECLIS study that goes back to 1993 to 2010. The differences are pretty significant. And then you can look at it like various aspects of it, like employee well-being. And so here, Alex Edmonds has done some interesting study that shows like very deep annual outperformance. The question is, it always remains, okay, did we fit the data to come to a certain outcome? Is the data sophisticated enough going back, such a long time? But still, with all these caveats, certainly the company data seems to be supportive for now. The second piece is the fund data also seems to be supportive, because you can look at it also from a fund data, like what are the funds that have been out there for a while pursuing that strategy, and on the whole, they seem to have outperformed. Now, the data is very sparse because it's a relatively new strategy for funds to focus on. But we have, prominent examples like Generation, right? The David Blood and Al Gore set of funds, and it's always difficult to say, well, is it idiosyncratic, right? Versus something about the approach. The third thing I would say is that it's certainly credible from a process perspective. Because if you say, okay, we're going to buffer our investment process by embedding environmental, social, and governance factors in it, I would say, yeah, of course, right? Particularly to the extent that you focus on the items that are going to be material to your specific industry, to your specific company. Of course, it's going to be a force for good for your returns. And to the extent that you're preempting or you're moving ahead of some perspective that there is a probability that new regulations will come in place, for environmental data for environmental issues, then yes, I mean, this is very much a strategy that makes sense. Now, I should say, when we say ESG is going to be a positive alpha strategy, I would say we're making an implied assumption here that markets are not efficient, right? Because if they were efficient, then all we're doing is like putting some sort of a constraint on our investable universe. And so we're constraining the optimization, and that would diminish returns. But this being said, is we know that markets are not efficient in all sorts of ways, including the fact that they tend to be short-term focused. And so that, I think that's an important point. And the reason why this ESG revolution is so fascinating is because we're at the point that, so of course, the vast majority of institutional investors, they have a fiduciary duty to maximize their clients' returns. But what's amazing about ESG is that it fits within that framework, right? Now we're talking about risk management for material risks that other people are very focused on. And now you may find yourself in a hard spot if you have a traditional fiduciary mandate and you're not focused on ESG factors. And that's an incredible change from the previous iterations of ethical, sustainable investments. Rob, you were going to say.
It's a complete shift. It has become a regulatory defense, if you like, for a license to operate or a justification for process. I agree with you. It's an incredible shift.
Yeah, and I'll mention, of course, as we all know, there are huge challenges, and by far, as we all know, like standardizing metrics. I mean, it's very easy to measure financial returns. It's incredibly hard to figure out social returns, and as we all know, standards have proliferated into what a lot of people.
And also, it's a moving target as well. I wanted one of the questions I have in mind to ask in the discussion is about that this ESG is really a movable target because it depends on the science. And then also there are other aspects like food, for example, which has, again, several different aspects. There's a global crisis in obesity, for example. Do you include that in ESG or not? No,
I mean, it's incredibly difficult because, I mean, I'll give you my experience. For my class, I've set up, all sorts of meetings and Zoom sessions with ESG funds, all the way to impact investment funds, right? So the impact investment funds, as you know, are at the end of the spectrum where they actually have they have a dual mandate, which is actually to generate attractive financial returns relative to their risk and to have social impact. And even for them, where they're really focused on their performance on social impact, every single fund we've talked to, they have different metrics. And it's such a huge challenge for the industry. Now, I would say what's interesting is that the amount of effort that's going into the process of identifying common metrics and the standardization is staggering, right? And it's so painful. And I'm so glad in some ways I'm not involved in it because it feels like such a hard thing to do. And there's no question in my mind that like 3 years from now, or I don't know when, the industry is gonna, you already see the convergence, right? Like you already see like there's such an urge from all the players to want to see that convergence. And I'm so indebted in some ways for all these people to do that, like in some ways thankless job, because eventually everybody's going to have to defer to someone else and to accept someone else's, metrics. And so I'm deeply grateful in a sense that there's so much happening, but it's painful. And Rob, you must be involved in that process in one way or another.
I don't know to say too much, JC, because coming from the bank side, standards, disclosure, metrics in terms of what's acceptable in, say, the green loans and green bonds markets that then feed into a supply of capital from the buy side, as you know. So I better not say too much because it is a very, very hot topic with the regulators today. And from the bank side, in terms of our activities and our justifications and our license to operate with our clients, going back to your 4 pillars, it's a highly complicated area of development. So I won't see too much. And also, JC, I've got a dash now in terms of I better get back to my day job of that. So it's 9:30. But thank you very much indeed.
Thanks for having been on.
Thank you, Rob. And I hope you can join our events again.
I certainly will. It's really interesting to hear such a theoretical and practical balance of the discussion. The theory and the in practice balance is so important as we look to run our businesses day to day. So thank you very much indeed.
Thank you. Thank you so much. JC, I would have 30 more minutes if you like. Or how is your timing situation?
Sure, I can do. I can do that.
If you want, maybe if I may ask a question, one of the questions I wanted to go deeper in is that we are really in contact because of Japan. Michael Banner initially introduced us, I think 2 or 3 years ago, regarding your work in Japan. And I'm here in Tokyo now. I'm focusing 30 years on Japan. So, and I was also board director of a company here where I was on the practical side of corporate governance, you know, and there's a lot of discussion about corporate governance by people who are not board directors or have never been board directors. And board directors are one of the cutting edges of corporate governance. The other cutting edge, of course, is the type of activist investor role which you are following. And there are different shades of activism, of course. So if you want, I would be very interested to talk a little bit about corporate governance issues in Japan in the broader sense, and the enormous, I completely agree with you that there's enormous value to be had in the sense of social value in Japan primarily, and secondarily, you know, cash profits. Following, you know, our shared philosophy, and I'm sure also the viewpoint of the Japanese government, which is more interested, of course, in general well-being of Japan rather than profits for one part of the society. No?
Yeah, no, absolutely.
So my question there is really, you know, when I was a board director here, one thing is that I spent to learn about doing my job as a board director better. I was spent a lot of time studying about corporate governance, both generally and also specifically to Japan. And one thing, of course, which is very important is you mentioned that corporate governance is often seen in the financial industry as a way to extract more cash to shareholders, which I'm very familiar with that viewpoint, you know. But in my work as a board director, I came to the conclusion that my primary obligation is to serve the company, you know, to make work towards the success of the company primarily, and shareholders as one of several, you know, parties in the game.
Right.
Shareholder, and usually my view was especially the larger shareholders have enough power, you know. So as a board director, I saw my job more the operational improvements in the company, you know, which it's a Japanese company. I was board director on the Japanese stock exchange, and everything was in Japanese language, and all the other board directors were Japanese. So I was the only one bringing out outside views. No? So I think that it's very good that you pointed out that corporate governance is not just extracting more money for the shareholders. That is an important factor, but it's one of many. And maybe not always the number one, because it tends to be short term. No?
Oh, absolutely. Absolutely. And I'll mention, you know, one tremendous, I mean, you know, I mentioned very early on that I've studied role models in the industry, and I've written about.
Yes, that's a very interesting point you made in this discussion with Professor Brunnermeier, which I watched on YouTube.
Oh yeah, and so one person I wrote about is Nick Benish, who you probably
I know him well. Yeah, know him for a long time.
Yeah, of course, and he started BDTI, right?
That's right.
Not-for-profit, which is really about training board members in Japan, because what you did was admirable, but it's also, you're probably one of very, very few board directors in Japan who went through the process of trying to understand what your responsibilities were, to study it, and then to try to...
I put enormous amount in. For my first year as board director, I spent maybe half of the time for two things. One is analyzing the company, three things: analyzing the company, analyzing the industry, understanding the company, understanding the industry, and also studying about corporate governance very generally. You know, I read, for example, the British case report and a lot of the literature in this field too. And plus, of course, there's Japanese specifics. One of the problems I had, and which I think you address this also in this discussion with Brunnermeier, is how do you actually create change. Essentially, this company hired me as not hired, but got me as a board director, appointed me. Yeah, appointment is by the shareholders, but they proposed me to the shareholder meeting and the shareholders appointment. Yeah, so one of their expectations they got me is to bring change to the company, which I did. So I analyzed and I created plans for change. I started with small things to get trust, build trust, and then I made bigger and bigger requests for change. I was very careful that I didn't use the word proposal, because as a board director, I use the word request
in Japan.
or the Japanese equivalent, because as a board director, I'm not an outsider, but I take care of the decision making. I take part in the decision making. But still, essentially, you have most of your power is soft power. So it's convincing people, the other board directors, the CEO.
Sure.
So I had many dinners, one-to-one meetings with the other board directors and CEO. And so I was thinking very much about how I can actually, get the CEO to accept my point of view and, go into the direction which I think was good for the company. And actually they picked up most issues, but mainly soft power. And you address this also in your discussion with Bruno Meyer regarding, people who recently joined the company or people at the top. And as a board director, you aren't really at the top of the company in a way because there's a CEO. But as a board director, one of your key jobs is to potentially fire the CEO if necessary, which is very probably unheard of in Japan, more or less. But in US, that happened. So what's your view on how to actually, as a board director in the sense of corporate governance, to actually make the changes happen you want to see happen?
In Japan, it's tough.
Yeah, I know.
Yeah, in Japan, I mean, as you know, right? In Japan, it's tough.
But there are some good examples which I can mention in a moment, which I'm sure you know as well.
Yeah, I mean, there have been some interesting examples. Olympus is an
exactly. That's the one I wanted to mention. Yes, exactly.
Yeah, I mean, that's an interesting one because Olympus, they actually invited Value Act to join the board. So, and Value Act is, I mentioned their shareholder activism that have longer lockups that allows them to be more thoughtful about how they create value, and Value Act is one of them. And they clearly demonstrated that they were able to add value to the management team. And so that's something that you just haven't seen in Japan, right? Like it's a rare occurrence.
There are some cases, of course, but that is a very prominent case and recent. And it happened only because of this terrible crisis.
Right.
The interesting thing is also that I read an interview with the current Japanese CEO, I forgot his name now, and he was also discussing the very beneficial relationship he as a CEO has with Value Act. And one thing which was very interesting is maybe you've seen that Olympus has recently distanced itself of the camera business and to focus completely on their strongest business and completely different business, which is the endoscopes and the medical sector. No? And he was saying that Value Act never directly pushed for a dissociation of the camera business sector, but Value Act kind of supported immediately when that idea came up, but they kind of did what good teachers do, is, they let do active learning or let the pupils discover the learning on their own,
Yeah, and I suspect that one way in which they might have done this is by doing all sorts of analysis and sharing analysis that led to the conclusion that they would be better off divesting, but letting the president of the company make that decision.
I did exactly the same in my board director work. I made like the company was board director, GMO Global Sign now. They have several divisions, so I I did, as a board director, you get a lot of financial information, and you can ask for information which isn't publicly, which is secret. No? So I could make quite in-depth analysis of the different sectors of the company I was board director of. And then, you know, I showed consequences of future developments and made concrete requests. And with financial analysis and financial data, very data, you know, I'm a physicist, so I'm very data driven. So, and they picked up, as far as I can see, they picked up almost all my things I pushed for.
No, I mean, it's great. I think historically, Japan boards have had less power just because they've never been independent. And so as a result, when you try to create change in Japan, like you don't, in some ways, you don't start with the board, you just focus on the president. But that may be changing with the corporate governance reforms, right? Because now they're trying to create, like, have more independent and thus powerful boards. So we might see, you know, different dynamics. But even for us, as you know, we're in an engagement fund in Japan, we would not necessarily think of going on boards in the way that in other countries,
Olympus
in Europe, or in the US.
Value Act did for Olympus.
Right, but that was unusual. And they felt they could make a difference through the board, and that's great. But it's historically that hasn't been the kind of a conduit for change in Japanese companies.
It was actually when this right after the Olympus crisis, there were some private equity investors who tried to make investments in Olympus, and one of them, through recommendations, asked me if I was willing to be board director of Olympus. At that time, it didn't happen. But I think there are many more attempts or proposals or you know for foreign board directors or Japanese board directors, independent board directors put forward by private equity investors. And I know of several cases where this is not successful.
Right. Yeah.
But I think another point there for the board compositions in Japan is that still today, a very large proportion, I don't have the number in my mind, but a very large proportion of the board members are predominantly internal board directors. And
and that's why, like, the power has never really resided in the boards, because they're primarily employees. And
many
so
of
as
them,
a result, they inherently defer to the president, and it becomes more of a rubber stamp than anything else. But now we're starting to see boards that are real boards with committees, right? With an audit committee, like a compensation committee, a nomination committee. So that the dynamics are changing, but very, very slowly. And it's still not our intuition for us to want to be on a board in Japan as the main way to affect change.
Oh, yeah. There's, of course, also an issue of conflicts of interest there. I mean, if you are on the board of a Japanese company, you have a fiduciary duty to that company in addition to your fund.
But I mean, like, I don't know that we would think of that as a conflict of interest if we're longer-term investors. But yes, sure.
It's, I mean, there's no law. I mean, conflict of interest is an interesting concept because it's not like insider trading. I mean, insider trading is a criminal issue, but a conflict of interest is really a case by case issue.
Right.
There's no crime equal conflict of interest, as far as I know. I'm not a lawyer. I get this conflict of interest question. I get in many contexts.
But there's an interesting evolution with boards, but it's still the case that I mean, like, poison pills is a good example, right? Like, poison pills could not be in Japan, they could not be authorized by a board, whereas in the US they are authorized by a board. in Japan, the way they're authorized is typically it's the president that will kind of propose it and then bring it to the shareholders and then have the shareholders vote on the poison pill.
But in every country now, increasingly recently, you have another poison pill type issue, which is government approval for investment in critical industries. And I think the regulations in all countries have been tightened now recently.
Yeah, they've been tightened.
Poison pill in the traditional sense, but it's kind of a government voice in investments.
Yeah, I mean, in the US, they were tightened several times. They were tightened in 2007. And then in a way that was very thoughtful, I thought. And then they were tightened again in 2018. So it's called CFIUS in the US.
Yes.
In Japan, they were in some ways tightened very drastically a couple of years ago through FEFTA. And that's been a challenge for a lot of foreign investors because of the confusion around it, and the government has, Someti has done a lot of efforts to try to do outreach and communicate exactly what they meant. But it's a pretty challenging, like a much more rigorous law than it was in the past.
Yeah, Japan is fascinating. I mean, I'm here now. And how much percentage of your work concerns Japan investments, and how much
it's
in terms
more
of
than 50% right now.
And capital?
Yeah, it's more than 50%. Yeah. So that's why I'm typically in Japan every 2-3 months.
Yeah. And now you video.
So I'm with Japan on Zoom very often in the evening as a result. So it's not unusual at all for me to do a Zoom with someone in Japan in the evening.
That time frame,
Yeah,
I'd be very interested to discuss more with you about Japan. It's
sure,
huge opportunities, and who knows, maybe there's a way to cooperate in that.
Right.
There's just so much value to be created by, I mean, one is all this kind of financial sophistication, but another factor which I think you mentioned also is opening up to outside ideas, and because you have many other companies here, too many other companies in Japan are very inside oriented, and they could create enormous new markets for their technology by becoming strong outside. I mean, I at the moment, since last year, I work mainly, one of my major projects is building up a pharmaceutical regenerative medicine cell therapy venture, Japan business, and also working globally on the finance. And in Japan, the pharmaceutical industry has many strengths. It's very strong.
Yeah, sure.
And but it's far less global than it would be for a company like Novartis, for example, or Pfizer.
Right.
So there are quite a few Japanese pharmaceutical companies who have great products, great technologies, great scientific know-how, but very little global reach. They could get a lot of benefits by having more international impact.
Oh, absolutely. I mean, of course, the challenge facing every Japanese company is that domestic market is shrinking. And what we have found that in some of our investments, our focus has been to help the company develop an international expansion strategy. So we almost end up acting as their strategy consulting arm, in a sense, to look at various markets and geographies around the world where they could expand profitably.
There's maybe, I think we are coming more or less to the end. There's maybe one more point which I thought to mention, because it refers to the previous discussion event which we had here in Trinity in Japan, which was with Sir Simon Baron-Cohen, who is one of the global authorities in autism. And so preparing and having this discussion, I learned enormously much about autism. And what I learned is that there's a concept of neurodiversity you know, which was new to me, and I learned about that. You know, when you ESG usually includes always the concept of diversity, and people, there are different ways you can think about diversity, no? And one aspect which was new to me is neurodiversity, in the sense that what Sir Brian Cohen, he developed, or he invented, or created a way of looking at autism, which says that, in a simplified, put simple now, is there's like two dimensions. Everybody has a spot on. Like you will be in some spot in this two-dimensional profile, and I will have a different one. And one axis of this two-dimensional space is empathy. Empathy means understanding the feelings of others. So, for example, when I'm talking to you now, you know, it's deeply wired into the brain of even animals, but mainly humans, to feel for others' feelings. Now, I have a kind of wired into my brain that I can, I have a feeling for your feelings. No? That empathy is one of the axes. So there are people who have stronger feeling for stronger, how do you say, stronger empathy and weaker empathy, less developed empathy. So people who will be more autistic on this autistic spectrum will have be lower on the empathy scale. No? Women usually typically are higher on the empathy scale than men are, for example. Not all, but generally. And the other dimension is Sir Simon calls it systematizing. So this is like it's the ability for science, mathematics, systemize. You know, it's logical thinking, and that's the other orthogonal axis. And so he says that through evolution, society, human beings need to be somewhere on this scale, and there's a need to have diversity. So you need people with high empathy in society, and you have people with high rationalization, high mathematical engineering skills. You need both these extremes, and so that is through evolution. There's a need for that. So autism is not an illness. It's just part of that evolutionary need which has evolved. No? And so from that, he created this concept of neurodiversity. So that was new to me. And so it's a very interesting aspect of diversity. So I think this diversity is also kind of a moving target, because many people look at men, women, or racial, or foreign, not foreign, but I think neurodiversity is another, or sexual, or gender identification is another one. And there may be new types of diversity coming up.
Sure. I mean, ultimately, diversity is seen as helpful to performance because it prevents groupthink.
Exactly.
And so there's no question that if you have a certain, like a whole spectrum of diversity in the way you process your thoughts, then presumably that would have an impact on how you think through issues. So presumably that would be helpful to fight against groupthink.
I think that's exactly why evolution, Darwinian evolution led to the presence of autistic. Everybody has a little bit of autism in them, even if they're not clinical, even if they're not don't have a diagnosis of autism. So everybody has. So there's a need in evolutionary sense. There's a need for that type of diversity. So diversity is not something which we are now saying we use as a kind of political term. It's really something which is deep in human evolution.
Oh yeah, interesting. Well, I should go back and watch that video.
I'll send you the link. Thank you so much today.
Well, Gerhard, thanks so much for having me. This was a lot of fun.
It was great fun, and I learned so much from you, and it will be fantastic to carry that on and maybe cooperate on Japan.
Yeah, absolutely. Yeah, no, I mean, I look forward to, continuing to being involved in the Trinity community in Japan. And and look forward to, I will let you know when I'm back in Tokyo.
Yes.
Yeah, absolutely.
Thank you so much today. Thank you.
All right. Thank you
very
again.
much.
All right.
Bye-bye.
Bye-bye.
Bye-bye.